Let me start with the opening remark because this is the only obligation on my part. So let's just briefly discuss this opening speech. Thank you very much for participating. Yes, we all live in the most challenging times as part of the ABMI, which is Asian Bond Market Initiative, and ASEAN Plus 3. The APCF offers an excellent platform to facilitate the exchange between experts and market practitioners in increasingly important collateral markets. In that context, I'm happy to have this seminar on collateral, the cornerstone of the financial system and the underpinnings of financial stability in turbulent times, and the most underutilized resources in Asia for financial planning. After the global financial crisis, we witnessed the increased demand for specific collateral types, the US Treasuries, and the regulatory pressure on unsecured money market transactions reinforced the shift toward the collateral transactions. Most central banks with QE sit on vast amounts of collateral, given the globally systematically important banks became under increasing pressure to respond to regulatory changes, especially with liquidity. Commercial bank deposits are pushed out to the central bank balance sheet. Large foreign repo pools and the CCP deposit accounts at central banks also imply an expanded role for central bank balance sheets. The result is the increased role of central banks in the global funding market. With the COVID-19, central bank QEs have been further extended, and the direct fiscal stimulus is unprecedented. We see the QE unlimited globally after the COVID-19 is twice the size during the past decades after the global financial crisis. Also, there has been an emphasis on CCPs that mitigate counterparty risks and reduce reliance on costly collateral via netting. Collateral has become a centerpiece in financial plumbing and financial stability by all accounts. Due to the authorities' massive intervention and the timely response by the Fed, Asia is doing relatively okay. Still, we expect further vulnerability from asset bubbles and market volatility during the recovery phase. Asia has neither the machinery for financial plumbing nor pleasurable assets. This is the problem. These emergency measures, despite the favorable outcome, entails serious side effects, and we need to be prepared. It needs some attention that Asia's exposure against the external shock is on the rise. Simultaneously, its capacity to address the situation is limited due to its severely depressed collateral use. Even in the COVID-19 era, the US repo disturbances have been channeled into the FX swap market in peripheral countries with an even more substantial impact on the overall economy. We see greater polarization as a result, and a large-scale dislocation of labor forces. We need to think about something that we have ignored to address these issues, which is the cross-border asset pledgeability. By using collateral for cross-border financial plumbing, we can expect more active engagement by private sector market participants. By all means, the key to financial plumbing in emerging markets is to increase collateral utilization in the cross-border setting via enhanced asset pledgeability. Therefore, central bank collateral arrangement plus central bank swap arrangement plus FX reserve would provide a possible strategic choice for Asia to allow more active utilization of collateral beyond the national borders. Who else other than central banks can lead the initiative to mobilize crucial resources for financial stability? We need both market infrastructures, regulatory harmonization, and a renewed sense about collateral utilization beyond the national borders. In short, we all strive to achieve financial stability, liquidity, risk management via better utilization of collateral resources we have in Asia. Given the limited balance sheet space at the private sector banks in Asia, the central bank balance sheet demand will remain important. It is a great pleasure to have Repo as our speaker for discussing the central bank collateral framework. As the renowned authority in this field, Repo will discuss the importance of central bank collateral framework and its implications for Asia. Josh Galper, a premier consulting firm on securities finance, will talk about collateral management strategy used for financial stability and growth. He's also most updated on related issues, and his expertise and the insights need to be shared with broader audiences in Asia. He also mentioned some possible opportunities for Asia. Thanks to Mr. Yamadera's ABMI, Asia's bond market is increasing, and the Green Bond Initiative especially are catching up global attention. The problem is that Asia is still vulnerable because most of the assets have limited cross-border pledgeability and cannot be used for global financial plumbing. And he'll give a detailed explanation of what can be done. Victor Van Dong will talk about ways to connect government bonds with the international ecosystem via ICSD, which is Euroclear, Clearstream. From funding to risk management, Asia's assets need to strengthen its use for the repo and derivatives market. More active capital market participation will significantly change Asia's financial landscape as one of the most important global financial centers. We also have a distinguished panel of speakers, panelists worldwide. Professor Duffy is a de facto Nobel Prize candidate and a world-class expert on the Chinese financial system. Dr. Manmohan Singh is the ultimate guru of collateral and financial plumbing. Among market experts, Hassani is the pioneering market player who recently closed the critical deal with China. Dr. Kim is our intellectual leader as ex-president of the Korea Economic Association, and Dr. Lim is a de facto world-class scholar in international finance. I'm sure they will share their insights and experiences to help us prepare for the future. Finally, Asia has become a possible solution to the global plumbing issue. Thank you. That's my introduction. So I think, Diva, it's your turn, basically. Without further ado, we are ready.
Yeah, should I share my screen? Might be better so I can control my own slides.
저희가 넘겨준다고 그랬어요.
Okay.
아니, 말씀했어요.
I don't know.
슬라이드를 넘겨준다고 말씀해주세요.
Oh, we okay. Just to say what next. All right.
Okay. Would prefer to share use my own slides. Is that possible?
I think I can see your slides, no problem.
Yeah, no, it will go smoother if I do it myself.
저분이 직접 슬라이드 share screen.
He controls the slides.
Professor Neighbor, hi.
Yes.
Can you hear me?
Yes.
Can you share your screen? Can you do that on the bottom of the page?
Yeah, I can't share while you are sharing. You
Yeah.
need to stop sharing, then I can share.
저 이거 share screen 어떻게 드리죠?
Okay.
Okay, so you can all see my screen?
Yeah.
Okay, great. Okay, so let me just say it's a pleasure for me to participate in this year's Asian Prime Collateral Forum. It's 3 a.m. Here in Zurich. And this reminds me a little bit of when I was working on a tanker as a young man and was assigned to the 4 to 8 watch. Hopefully I'll be a little bit more awake this time. So tonight I've been asked to talk about collateral frameworks. As I understand it, there's an objective to reduce dependency on US dollar denominated collateral in cross-border transactions. And to make progress on that front, a pan-Asian collateral framework might be a useful thing to have. So with that as a backdrop, I'm going to discuss the collateral framework in the Euro area, which I think may be especially relevant in a cross-border context because it is designed to work for a large number of sovereign nations, albeit under a common currency. So looking to Europe should be given indication as to the challenges that might arise with respect to setting up a pan-Asian collateral framework that does what you want it to do without too many negative side effects. My talk will draw on my book that I put out a few years ago on Cambridge University Press, which was called Collateral Frameworks, the Open Secret of Central Banks. My starting point is that money matters. It matters because it facilitates and underpins economic activity. And as Walter Bagehot wrote in 1873, money is economical power. I think you can see this clearly today with the rise of cryptocurrencies and the Libra project as an example. It's also implicit in that part of the Bagehot rule that says the central bank should provide liquidity not only against good collateral, but also at the penalty rate, because money is valuable. And you don't just want to hand it out just like that, even to needy banks. The money at the core of modern economies and financial systems is central bank money. Ultimately, most transactions are settled in central bank money, and there's no substitute for it. And this gives central banks influence and power and, of course, responsibility. But the point that I want to emphasize here is that money is issued against collateral. So if money is power and money is issued against collateral, it stands to reason that it's important to understand the nature of the collateral and the terms of exchange between collateral and money. And this is determined by central banks through their collateral policies and also to some extent through their interest rate policies. And while the latter is well covered by central bank communications, the media, and academic writings, collateral policy is much less well understood. And collateral frameworks basically describe and define collateral policy. But for the most part, they're opaque and haven't received that much attention. So I wrote this book to remedy this, to bring to light the functioning, reach, and impact of central banks' collateral frameworks. And the book uses the collateral framework of the Euro area as a basis of illustration. So what I want to do tonight is to share some of the ideas in that book and some of the findings of my research. And hopefully this will yield some broader lessons that are relevant outside of the Euro area. To put collateral frameworks in a broader context, I thought it would be interesting to take a look, a cursory look at central banks' balance sheets. And what you see here is that these have grown considerably since the financial crisis. For example, the consolidated balance sheet of the Euro system is now more than 7 times bigger than it was pre-crisis. And the growth is also apparent if we normalize by GDP. So pre-crisis, the consolidated balance sheet of the Euro system was approximately 12% of GDP. In 2019, and this is pre-COVID, it was about 40%. And the Bank of Japan has a balance sheet that is more than 100% of GDP. And this growth and the associated monetary policies have led a number of market participants to express concern. For example, in 2015, Yngve Slyngstad, the former head of the Norwegian Oil Fund, expressed the opinion that monetary policy affects pricing to such an extent that monetary policy itself has been a risk you have to watch. And this is, I think, in many ways, a remarkable statement. Now, some central bankers have also expressed concern. For example, Klaas Knot, the head of the Dutch central bank, said in a speech in 2013 that central banks' balance sheets are becoming more and more exposed to economic risk and political pressure. He and Thomas Jordan, who is also quoted on this slide, are referring not only to the sizes of balance sheets, but also to their compositions. And this is, of course, a function of central banks' own policies, and in particular, a function of their collateral policies. So collateral frameworks basically does 2 things. First, it defines the set of eligible collateral that banks can use to obtain central bank money directly from the central bank. And second, for each eligible collateral, it defines a rule that determines the quantity of money the central bank would provide against that piece of collateral. In a central bank repo, which is what I will focus on, this quantity is the collateral value within the collateral framework, which may be different from in the market. The collateral value is simply the collateral's price less a haircut. And the haircut is set by the central bank and is an important element of collateral policy. Different eligible collateral have different haircuts, and they are determined by things like their type, duration, and rating. Unfortunately, I won't have the time to go into details here, but I refer you to my book for further details on that particular point. In the euro area, there are 30 to 40,000 different securities on the public list of eligible collateral, and the exact number varies day to day. And these securities range from government bonds to unsecured bank bonds and asset-backed securities. And I have estimated that around 75% of these do not have market prices. So then you may wonder, what does this mean for collateral value? The answer is that if there is no market price, the Eurosystem uses a model to determine a theoretical price to set the collateral value. And haircuts are also not set by a market, but by the central bank. And historically, in the euro area, these are updated only every 3 to 4 years. In short, for most eligible collateral values have relatively little input from markets. They are set by the central bank. As a result, biases can arise either by design or inadvertently. And this can affect financial markets, the real economy, and the financial system. Now, if we believe that money matters, then securities with relatively low haircuts and high collateral values may trade at the premium in the market, ceteris paribus. Of course, to the extent that they have market prices. I provide some evidence to that effect in the book, and I have some further work on the way with Jiri Washitz with actually amazing identification that I would say confirms this contention. More generally, if the collateral framework favors certain assets, we would expect those assets to be produced by the financial sector and in the economy. So if the central bank has a policy of, say, channeling liquidity where it is needed through favoring illiquid assets, we would expect to see an overproduction of those illiquid assets. So as an aphorism to illustrate my point, if central bank money is only available against igloos or igloo-backed securities, then igloos will be built. We'll get too many igloos in the economy. For example, too many second homes, airports in nowhere, ghost towns where nobody really wants to live, inefficient uses of resources in various ways. Favoring illiquid assets in a depressed economy may make it harder for the economy to recover. And overproduction of illiquid assets or igloos also makes the financial system more vulnerable in the first place. So in my assessment, the Eurosystem's collateral framework can be characterized as seen here on this slide. I've already mentioned some evidence that speaks to the first point, namely the relative absence of market forces and discipline. And I will show shortly some evidence to back up some of these other points, and in particular, that it favors illiquid and risky assets. And after having done that, I will discuss some of the consequences. Let me just add here that in the absence of market forces, other forces will step into the vacuum. My research suggests that these forces in the euro area are rating agencies and politics. The importance of individual rating agencies is magnified by the collateral framework rule that says, with the exception of ABSs, only the highest rating matters with respect to determining haircuts. And as a result of this, at some point, ratings by DBRS increased the collateral value of Italian, Spanish, and Portuguese government bonds by around 200 to 300 billion euros in aggregate. Another important force, I believe, in the euro area's collateral policy is politics. And one avenue for politics to enter is through the upgrading of collateral values through government guarantees, which is allowed in that collateral framework. So overall, my analysis is that the Eurosystem's collateral framework is what I would describe as accommodative. So let me get to the evidence. What you see here is the composition of eligible collateral broken down into different types of collateral over time. And I've organized this so that what we may ex ante think of the best collateral is on the bottom. For example, the blue bars represent central government securities. The green bars on top represent ABSs and unsecured bank bonds. One thing you can see is that there is a year-on-year increase in the relative production of lower quality collateral before the crisis. And this suggests that these assets are favored, and also that there has been a buildup of illiquid and risky collateral in the financial system over time. Next, let us look at the corresponding graph for the assets that banks actually pledge to the Eurosystem. And this is my two-frame movie. So you watch the bars, and then you see the what they prefer. And as you can see, the green section are not much bigger and the blue section much smaller. Banks prefer to use lower quality collateral in Eurosystem repos. And this is also the collateral with the lowest incidence of market prices. So this also serves to illustrate a relatively small role for market forces and discipline in the Eurosystem's collateral framework, because collateral without market prices are not only eligible, they are preferred. If you look closely, you will see at the top section of each bar represents non-marketable collateral, which just strengthens the point that I'm making. And we may ask, why have such a big range of eligible collateral? Why include collateral without market prices? Perhaps there's not enough higher quality collateral to go around. Now, this slide speaks to that point. The red dots at the bottom of the blue bars represent the total liquidity injections from repos as a percentage of the total collateral value of all marketable collateral. So I see in this range, it's from around 5 to 9% over time. As we can also see, this is covered by central government securities by a large margin. So the system could run with only these securities as collateral, but it instead admits such a wide range of collateral can be interpreted as reflecting an accommodative collateral policy. So while there may be good reasons for accommodation, there are also consequences. And if illiquid assets are favored, illiquid assets will be produced, and even more accommodation may be needed when something goes wrong. Now, in December 2011 and February 2012, the Eurosystem conducted 2 3-year LTROs, each of which injected about €500 billion of 3-year money into the system. And this slide and the next relates to these well-known operations. What we see here is an illustration of the active usage of government guarantees in Italy to upgrade collateral so that it could be used in the second of the 3-year LTROs. As a result of this collateral upgrade program, which was admitted by the Collateral Framework, the number of banks in Italy with government guaranteed paper outnumbered such banks in the rest of the euro area by almost 3 to 1. What we see here is the exclusion and subsequent inclusion of around 10,000 unsecured bank bonds trading on non-regulated markets. Inclusion coming just in time to take advantage of the second 3-year LTRO. And these incidences arguably illustrate support to the holders of the papers that benefited from the government guarantee schemes on the previous slide, and the collateral inclusion on this slide. And the papers involved are, of course, highly illiquid. Unsecured bank bonds trading on non-regulated markets are just not traded a whole lot. Now, as I mentioned, if you have a very accommodative policy admitting and favoring illiquid and risky collateral, there will be a buildup of such collateral, and the danger is that more accommodation may be called for when negative shocks hit. And this slide speaks exactly to that. It provides an overview of the spiral of ever stronger policies in the euro area and the associated development of an increasing quantity of excess liquidity. The red line represents aggregate liquidity needs, as reported by the ECB, and the green line captures the actual quantity of liquidity that is injected. In the old days, the ECB used to run a liquidity neutral policy, injecting within each reserve maintenance period the quantity of liquidity banks needed in aggregate. You can see this by the red line covering the green line. In fact, in the early years, you can barely see the green line. That's how neutral the policy was. Of course, collateral policy was accommodated also at this time. For example, equities were allowed as eligible collateral until 2005. Then, after Lehman, the ECB introduced the full allotment policy, under which banks receive whatever quantity of liquidity they ask for, subject to posting adequate collateral. And this emergency policy is still in place, but it is now augmented by various and sterilized large-scale asset purchase programs, quantitative easing, which has influenced the market prices of the securities that are eligible for such purchases and have injected 3.2 trillion excess liquidity into the system. And this quantity of excess liquidity is so large that it exceeds the aggregate liquidity need. So the excess exceeds the aggregate liquidity need. And associated with this development, huge imbalances have developed, as I will shortly show. And this slide just shows the various asset purchase programs. I just want to point out here that the cumulative liquidity injection from these programs approximately equals the quantity of excess liquidity in the system. So the excess liquidity comes from the asset purchase programs, not the full allotment program. This slide shows the target to balances, and this completes the story of the imbalances in the euro area. And the story is this: fresh central bank money is printed, figuratively speaking, to buy various kinds of paper across the whole eurozone. Some German paper is bought, some Italian and Spanish paper is bought, paper from other countries are bought. Money flows into the bank accounts of the sellers of those papers, but the money that flows into Italian and Spanish and other so-called periphery country banks doesn't stay put. It moves to banks located in Germany and other, for the most part, northern countries. So while this may be collectively unfortunate, it is individually rational to the extent that periphery banks are risky. And one such risk could, for example, be the breakup of the euro. If that were to happen, it would be better to have your money in Germany rather than Italy, as an example. And the contention would be that these imbalances and the fragmentation they represent have been allowed to accumulate because of accommodation. Of course, without the accommodation, there's a big question as to whether the euro would have survived. And this accommodation is at the level of the collateral framework. It is also with respect to well-documented long-time breaches of Maastricht Treaty criteria. We see in the charts I have provided that as excess liquidity has grown, the imbalances have grown. Of course, these imbalances could also be viewed as the atomic bomb that serves as a deterrent to the breakup of the euro. What can we learn from all of this? First, institutions, governments, markets respond to the incentives built into the collateral framework. If market forces and discipline are de-emphasized, other forces will step into the vacuum. Third, an accommodated collateral policy that is generous to illiquid and risky collateral stimulates the creation of such collateral and the underlying associated real assets. And as can be seen in the last few slides, this can create the need for further accommodation if and when a negative shock hits. It can set up a vicious circle with ever stronger policies needed to keep the system intact. An accommodated policy is also an obstacle to the development of well-functioning markets. It's an obstacle to market integration. Finally, while I didn't really cover this in this talk, in the book I conclude that the fundamental problem with the euro is insufficient constraints on sovereignty. And I think dealing with this is a major challenge in the development of a cross-border collateral framework. Other, perhaps simpler challenges, but challenges nonetheless. One, what do you want to incentivize? Maybe you don't want to favor any particular kind of asset. Maybe you would like to have a neutral system. I suspect this would require marshalling market forces in the right way. So that's a challenge. Second, where to strike the balance between market forces and discipline on the one hand versus accommodation on the other. And as suggested by the experience of the euro area, an accommodative policy may be difficult to control when problems arise. So you need to think about that. Having a time-consistent policy may be a challenge. Now, challenge number 3 here is how to generate a role for market forces and discipline. Now here you need to think about what collateral should be eligible, how to determine haircuts, what should the role of rating agencies be. It's also important to have a liquid secondary market for eligible collateral. You want to try to promote it. While we might think that eligibility itself would promote a secondary market, we can see from the experience of the euro area that this is not a sufficient condition. Remember, most eligible collateral do not have market prices. And you will also have to deal with potential risks, such as buildup of imbalances and the accommodation that you then might be forced to make, and of course, exchange rate risks. And then let me just conclude very briefly by saying again, money matters, and therefore monetary architecture matters. And monetary architecture is the domain of collateral frameworks. And these have potentially wide impact on asset prices and the real economy. They're powerful monetary policy tools, and therefore serious thought needs to be put into their design. Thank you.
Thank you so much for your thought-provoking presentation. It has, I think the questions and answers should be later, right? Because of time constraint. So let me just delay the questions and we'll go to the next presentation, which is I think which is Josh. I think Josh's turn. So we'll just delay until the end of this presentation, and we'll come up with some kind of a question and answer session. Okay. So Josh, it's your turn.
Great. Thank you very much. I'm going to attempt to share my screen. And that didn't appear to happen very well. With apologies, Zoom does not appear to be allowing me to share my screen. Do you have my presentation, or I can just talk through it? Wonderful. Thank you very much. Great. Very good. Well, first of all, thank you very much, colleagues at the Korea Institute of Finance and the Asian Prime Collateral Forum, for inviting me to speak with you today. It's an honor to be able to share my thoughts. I was quite impressed and have been impressed with you for years in the efforts you've been making around the popularization and work on the ideas of collateral in the Asian region. When I thought tonight about what I was going to say, I've been working on Asian collateral matters for the last 5 or 6 years. And in that time, a strong impression that I have is that there are many competing forces at work here. Market forces that encourage both the use of collateral and also unsecured financing, policy forces that encourage looks at regional economic development from different paths, and also work, of course, across the ASEAN +3 members to create a broader regional Asian economy. And I thought that my contribution this evening, my time today, your time, should focus around what really are the incentives for regional economic development that can be found by promoting collateral. The line of logic that I'm going to use here is that collateral has a fundamental role in economic development, in the real economy. And so my presentation is going to talk a bit about that and walk through why collateral is effective and why governments have a natural incentive to be encouraging collateralized transactions using local currency bonds. So to start out, local currency bonds effectively collateral using local currency bonds. This is a way to increase demand for local bonds. We have substantial evidence across many years, multiple countries, that when there is demand for collateral using particular currencies bonds, particular governments bonds, then there becomes more demand for those bonds in the marketplace. It's a self-reinforcing loop. So what we find is that collateralized short-term funding drives demand, which in turn lowers funding cost. As you all know well, when there's more demand for a bond, greater issuance, interest rates will be lower, liquidity will be tighter, liquidity will be better, spreads will be tighter, and this will benefit the issuer, which then in turn will be able to spend the proceeds of those bonds how it wishes at a lower cost. when you have a lower cost for governments, they're able to borrow at a lower expense. That's going to mean more predictable domestic growth, domestic investment, hence domestic growth. And that's really what we're looking for here. The relationship between collateral and hence lower funding costs can be traced both through data and economic theory. I'll be the first to say that the data are not Loctite. It's more anecdotal, and there are, of course, quite a large number of factors that could be modeled in that would lead to the outcome of what a funding cost might be. But economic theory states, and financial market theory states, that the relationship should hold quite nicely. So I'll be talking a bit about that. The collateral that we're talking about, or that I'm talking about in this presentation, can be based on long-term or short-term debt issuance. So that is to say, we could be talking about collateral of 30-year government bonds, or we could be talking about overnight repo funding. The fact that collateralized transactions are one of many inputs to government debt demand means that you will see in my slides that my arguments will not be the end of this conversation. However, what I hope to do is give the ideas, particularly to government policymakers in your circle, that collateral can be an effective tool for achieving their domestic policy, economic development growth goals. Next slide, please. So what we know for sure is that capital markets have expected transmission channels that reach into the real economy. I'm going to back up for just 1 second and say that again, because I think it's very important. Sometimes we talk about capital markets as if they're a world unto themselves. And then over on the left, there's that separate thing called the real economy. But in fact, there's very clear feedback loops here. In the context of collateral, when a cash lender accepts government bond collateral, that means that collateral has more value to both the borrower and the lender. So there's more liquidity for that government bond in that marketplace. The more liquidity, the tighter spreads and lowering borrowing costs that I discussed in the previous slide. We already know that tighter spreads and lower borrowing costs lead to improved economic activity, which in turn creates more financial transactions and more demand for cash lenders to accept government bond collateral. So that feedback loop is pretty well known. I've delivered the slide here really so you have it on paper. In our experience in working in collateralized trading markets, sometimes these are ideas that are vaguely known, half known, and then when you see it on paper, you go, oh, of course, I knew that. But it's useful to have it right in front of you. Next slide, please. From the data side, what we know is that government bond bid-offer spreads support stable funding markets and macroeconomic policy making. So I've presented here some data from Asian Bonds Online, from the New York Fed, and also from Vanadium's analysis. And what we see here is that government bond bid-ask spreads in 2019 across many Asian markets were in the 0.5 to 6 basis point range. These are markets from Vanadium research, and you know as well, that are not overly reliant on collateral, where collateral is not it's active in all of these markets, but it's not a primary feature. In the US repo market is 52 times larger than the federal funds unsecured market. So quite a dramatic difference in the size and demand for overnight repo collateralized transactions versus unsecured transactions. And again, you know, I'm drawing a causality here. There, anyone could say, oh, well, there's this factor and that factor, but we can see clearly that the bid-offer spreads for US Treasuries are a fraction of what they are in most Asian markets. The idea that I want to draw out here is that the demand for collateral plays into what bid offer spreads are for government bonds. Again, as I've said before, my argument is not Loctite. You can poke holes in it, but our observation is that that demand for the collateral to such a degree in the US market, just as an example, suggests that this is a contributing factor to tighter bid offer spreads. Next slide, please. So when we look at sources of demand for collateral, one important source of demand is as collateral for OTC derivatives margin. And the flow here is that when two parties agree to conduct an OTC derivatives transaction, that end users have a variety of reasons for that. They can be trading a directional interest rate bet. They can be hedging a transaction in the physical economy. They can be trading a total return swap, where they're replicating an index as opposed to buying the physical securities. Under uncleared margin rules, initial and variation margin needs to be delivered. So you then have a demand for some sort of margin, some sort of collateral that's going to be delivered between the two parties. Initial margin must be eligible collateral, and government bonds are frequently used. The variation margin is in cash. We're going to leave that aside for now. The next step is that both of the counterparties are going to agree on what is eligible collateral using an ISDA credit support annex. This ISDA credit support annex can include local government bonds just as easily as it could include US treasuries or corporate bonds or equities. This is specifically an agreement between the two counterparties about what types of bonds are acceptable. And here we get into the conversation about, for Asian policymakers, what do you want to have happen to support your economic development goals? The idea that I present here is that two parties can accept local currency debt from Asian currencies without having to source outside collateral, especially for domestic or regional players. It's important to note that by being willing to accept collateral or deliver collateral that a market participant already holds in their portfolio, there is no drag on the portfolio as there would be if there were demand for a collateral transformation. By collateral transformation, I mean you hold securities in your portfolio that are not acceptable to the counterparty as initial margin, so you have to go out and engage in a swap or a repo transaction in order to obtain the securities that you need, or of course a securities lending transaction. So by being willing and encouraged to accept and deliver local currency bonds as collateral, there creates more demand for local currency bonds in the domestic market. Next slide, please. To get a sense of the size of what we're talking about here, ISDA's 2019 margin survey found $442 billion worth of initial posted margin by the 20 largest market participants. Of these, 84%, or $371 billion worth, were in government securities. These government securities are typically US Treasuries first and foremost, a wide variety of European securities, JGBs, and many others are represented. But if you think about your own country, if you were to gain a larger slice of that 371 billion as inherent demand for your country's local currency bonds, what would that do for you? How much could that move the needle in creating additional demand for your country's bonds? I don't have the data to say country by country how much that would be important, but it's a question that I leave with policymakers to consider about what the impact might be. Next slide, please. Another source of demand are local currency repo markets. Here, I believe you all know repo quite well. I won't go through too much more, but to say that the Asian repo markets are quite large at $3.1 trillion, and that's from Vanadium research that we conducted at the end of last year. However, That 3.1 trillion is, based on what we know, a fraction of the unsecured market. So it's great to say that there's 3.1 trillion in Asian repo, but how much more could there be? That's really the question. The data breakdown we have also shows that China is the largest part of the market. And when we look at countries like Thailand or Korea or Vietnam, it does raise the question to say, if those countries were to be more supportive of repo transactions, especially in the private sector for funding, as compared to unsecured, again, what could the result be? Next slide, please. So just to go through quickly what happens in an actual repo transaction, how is the demand sourced for local bonds? At the beginning of the transaction, there is a collateral provider and a cash provider. When the collateral provider delivers bonds, the cash provider needs to be willing to accept those bonds. So if the cash provider says, yes, I will accept local currency Asian bonds, then that becomes a very attractive trade for a collateral provider that already holds those bonds or would like to hold those bonds. As I mentioned in the example of OTC derivatives, it's not just that there's a requirement or a possibility for no drag on a portfolio based on what the portfolio already has. There also creates an opportunity to buy certain assets based on their eligibility as collateral down the road. Next slide, please. So just to compare the benefits of collateralized bonds in different transactions for financial stability versus unsecured financing, there's quite a number of benefits. And again, for policymakers, as you think about what kinds of transactions you want to support, I think this is these are valuable ideas to keep in mind. So first, collateralized transactions provide two-sided protection to investors. So it's a risk mitigation mechanism. In the event of a default, which happens once in a while, it's not an everyday sort of occurrence, both parties will know that they have collateral that can be sold in the open market to protect their positions. When you think about unsecured financing, this is really the goodwill between a bank and their counterparty. The bank says, yes, I will trust you, I will lend you money overnight. And if the counterparty were to default, then the bank would be a creditor and get some portion of their money back later. But how much nicer to have the collateral in your account right away. Later today, I know that you'll be hearing from a number of presenters and a number of ideas about the infrastructure and mechanisms of being able to account for collateral, all of which I believe are in very good shape around the world and entirely suitable for the Asian markets. That won't be my focus. Rather, I'll talk about the idea that a policymaker would say, you know, we want to encourage collateral as opposed to unsecured financing, and here's how we get there. Another reason for as collateral benefits financial stability is that securities can be bankruptcy remote. So instead of even any concern that a bank would lend unsecured to a counterparty and the counterparty would have the cash on the balance sheet and then default, collateralized securities can sit with a third party and never be on a counterparty's balance sheet. Keeps the transaction very clean. When collateral is used for different types of transactions, the collateral itself is transparent and risk can be measured. Professor Nyberg's example of non-marketable securities notwithstanding, most collateral that we see used in the repo and OTC derivative markets, private markets, are transparent. We see government bonds, we see corporate bonds, equities, commodities, all of which have a market price. And when you've got a product with a market price and you can measure the risk, that assists both policymakers and also individual institutions with understanding where their risk lies. So collateral can bring financial stability benefits, but it's best when combined with appropriate macro-prudential regulation as well. Earlier today, or Friday, I believe, the governors who oversee the Basel Committee on Banking Supervision said that they were effectively done with Basel III. And most countries have gone quite some ways in adopting the Basel III framework. When you think about what Basel III does in terms of constraining leverage, and then how collateral plays into Basel III and what's considered high quality liquid assets, which might be a topic that comes up later today as well, the use of collateral and macroprudential regulation really go hand in hand. It's very appropriate and suitable to look at collateral in the context of Basel III regulation rules to see how it fits and how it impacts financial stability for domestic players. Further, not just domestic players, but international players who would choose to use cross-border local currency Asian bonds in their transactions can also benefit, as well as their regulators will benefit, by having the frameworks in place to understand where collateral should fit. Next slide, please. So in conclusion, I'd like to say that an argument for collateral is an argument for regional development. And again, getting back to my initial comments, in coming into this presentation, I really gave thought about what will help move this conversation forward. What will help policymakers in the Asian Prime Collateral Forum audience think further about actions they might want to take to encourage collateral using their local currency bonds. And the answer that I've got is that it's an economic development argument to say that if a policymaker in a certain country were to encourage local currency collateral use, then there would be greater demand for their bonds, more stable borrowing costs, and hence improved regional economic development curve. So I've walked through the flows, if you will. So we've seen that there's encouraged demand for assets when they're eligible as collateral, that greater demand drives reduced bid-offer spreads, which in turn lowers borrowing costs. I've talked a bit about OTC derivatives and repo as two sources of collateral demand. One thing that I haven't gone into, because it's quite not the topic for this evening, but that the importance of collateral markets is similar to the development of cash bond and FX markets. And really, you could look at the three markets, being collateral, cash, and FX, as three legs of a stool. I wouldn't say the collateral in any way is going to, on its own, transform a local currency bond market overnight, but it can be a very important component. When Vanadium has done research on Asian local funding markets, both secured and unsecured, one thing we find is that the use of unsecured is often preferred by market participants. So encouraging the use of collateral then might require a more proactive approach by policymakers than you might find in other parts of the world, because you're working to change history, you're working to change comfort, but there can be very good reasons for this. And lastly, the arguments that I've drawn on this evening, or today, sorry, can apply to both domestic collateral demand and also regional collateral baskets. A piece of work that the Asian Prime Collateral Forum has done, and Vanadium has worked a bit on this as well, is how would a pan-Asian collateral basket work? If you think about what demand could be generated for the underlying collateral in a pan-Asian collateral basket, the idea that more demand for the constituents of a pan-Asian collateral basket would lead to all the same benefits that I've outlined in this presentation about one individual case of a local currency bond, the same principles will apply. I believe that about wraps up my time. Thank you very much for your attention. I'll be pleased to answer questions whenever we can get to them. Thank you.
Thanks for the great presentation. I think you know what we need and you provide relevant policy implications, so appreciate that very much.
Thank you.
And I think the questions will be postponed later, and we will go to Satoru Yamadera's next presentation. He's actually a crusader pioneer in this field, and he's going to have some presentation. But it has a very large amount of material, so please use the time constraint to.
Yeah. Well, I won't explain
Okay.
all the slides, but the point I'd like to highlight. I mean, my role here today is to share the sort of a regional discussion, give some sort of an updates.
Okay.
So I won't explain all the slides in detail, but hopefully I can give you the sense that what sort of a discussion have been made already, and what will be the next step for this region. Next slide, please. So for those who are not familiar with ASEAN Plus 3, ASEAN Plus 3 is the ASEAN 10 countries plus China, Korea, Japan called ASEAN Plus 3. And this forum was established after the Asian financial crisis. So we've been working as the kind of secretariat. Next slide, please. Yeah, so ASEAN Plus 3, we have two pillars, Chiang Mai multilateralization, which is kind of swap agreements among the member countries. And today our focus is Asian Bond Markets Initiative. ADB plays the secretariat role. And under the ABMI, we have 4 task forces represented by the government officials, kind of a director working level task forces. And the task force 1 focuses on supply, how to create a local currency demand. Task force 2 focusing on how to create more demand. And the task force 3 focus on regulation, and the task force 4 focusing on the infrastructure. And Asian Prime Collateral Forum sits under the task force 4. And this regional discussion eventually will be elevated to the top ASEAN Plus 3 finance ministers and central bank governors meeting. We don't have kind of institutionalized regional cooperation like Europe. We don't have European Commission, but this regional forum discussion actually delivers some concrete outputs. And always we try to deliver some tangible outputs every year when the finance ministers, central bank governors meet together. So my focus will be first the ASEAN Plus 3 Bond Market Forum, which is under the Task Force 3, and also some of the discussion under the Task Force 4, and particularly focusing on the Cross-Border Settlement Infrastructure Forum. So next slide, please. Yeah, the next slide. Yeah, when we started the discussion in early 2000, the focus more on the kind of a policy among the policy makers, how they can sort of understand the importance of local currency bond markets. But around 2010, the government came to realize we need to invite private sector more. So we established the ASEAN Plus 3 Bond Market Forum 2010, and this functions as a common platform to bring private sector, public sector experts. And we've been discussing various initiatives under this ABMF. Next slide, please. So collateral, cross-border collateral is one of the topic, and I don't need to explain these in detail, but as you can see middle, the chart, the local currency bond outstanding in this region has really increased a lot. And currently the size of local currency bond market for ASEAN and China, Korea is about the US Treasury market. So if we add Japan, it's twice as much. So in ASEAN Plus 3, all the local currency government bond, local currency bond in total is twice as much of US Treasury, and close to twice as much as euro-denominated euro bond in euro area. So it's quite sizable. But still, the use of local currency bond is limited, and that was really the question. Next slide, please. So we conducted the study and survey in the 3 steps. First, we tried to identify the cross-border transaction flows and then conceptualize the typical flows, and of course, identify the problems and impediments. First, the transaction flows. So next slide, please. The next. So I won't go through it in detail, but we try to understand what sort of cross-border transaction is happening, particularly the cross-currency and cross-currency and also cross-border collateral. So we looked into those transactions in detail. Please skip all those slides up to slide 24, the conceptualized typical cross-border transaction flows. So the when we see all the transactions, basically we can summarize into some typical flows. The first one is the possible transactions. So two banks agree to do the cross-border collateral. But in this case, typically the two legal documents and also understanding is necessary. But let's say the bank A, for example, Japanese bank in the Hong Kong branch and HSBC in Hong Kong, they agree on the securities lending, and they also in Japan, the HSBC Tokyo branch can provide funding to the Bank of Mitsubishi in Tokyo, or vice versa. So this is one possible way. Next slide, please. Also, in this region, ICSD, like Euroclear or Clearstream, provides the tri-party repo. But the securities which can be provided through the tri-party repo is limited. I would say normally only JGB. And this is because Asian currencies and bonds are not allowed to be settled offshore. And as you know, the Euroclear and Clearstream are offshore, offshore sort of ICSD. So that is the reason it's not easy to find that kind of arrangement. In this region, mostly JGB, Aussie bonds, and some extent CNH, offshore renminbi bond. Next slide, please. The next one. Yeah. So the ICSD do not have branches in each jurisdiction, but some of the global custodians or regional custodians may have branches in all jurisdictions. JP Morgan has branches in Japan, Hong Kong, Singapore. Deutsche Bank has branches almost all the ASEAN plus 3 markets. So instead of ICSD, those global custodians may be able to provide the tri-party mechanism, which is sort of, this is kind of a hybrid of the first case and second case. And we found that this is probably one solution. Previously, one of the global custodians really liked this idea, and they tried to establish some operational framework. Unfortunately, given sort of the market disruption, various things, unfortunately, this idea didn't materialize. But this is one of the ways to create cross-border transaction in Asia. The next slide, please. Also, we would like to promote central bank connection. If central bank agrees on the cross-border collateral arrangement, they can create the larger collateral pool. And already, some of the central banks already agree this cross-border collateral arrangement. For example, Bank of Japan have agreed with Bank of Thailand, MAS, also BI, and the BOJ also made agreement with BSP for the cash collateral. Likewise, it's not publicly announced clearly, but some of ASEAN central banks, they already agreed this cross-border collateral arrangement scheme just for the emergency purposes. Next slide, please. In order to facilitate such central bank arrangement, ASEAN Plus 3 agreed to create the we call it CSD RTGS linkage. This is the system link between central banks and CSD to facilitate the cross-border collateral and repo. Next year, early next year, Bank of Japan and HKMA will implement the cross-border cross-currency DVP system. And hopefully this can be the first case in this region, and other central bank will follow this sort of linkage. And well, this central bank, I mean the HKMA and the BOJ arrangement is to facilitate the market cross-border cross-currency transactions. But of course, hopefully through this linkage, we are hoping to create more sort of cross-border collateral agreements among the central banks. Next slide, please. Next slide. Well, through these identification of transactions, we encounter a few problems. First, invisibility of transactions. It was very difficult to identify the size of cross-border transactions because simply we don't have the data, and even the ICSD, they don't collect the data to categorize what is repo or what is sales and sell and buy of securities, because normally the repo, the repo transaction, they don't differentiate the ordinary outright sales and the purchase of bonds. And also based on the anecdotal information, we hear the use case of cross-border collateral is very limited, only JGB or Aussie bond. So that's really creates the problem, because invisibility of transaction itself become the barrier for this cross-border collateral transaction. So we need to get more information to understand what is happening in this market. Next slide, please. Actually, the biggest challenge we found was the differences in the legal arrangement. Even the between Malaysia and Singapore, those are the common law countries, and they have close businesses. But one case we realized was the Singapore banks, Malaysian banks, they do the repo in its own market. But when it comes to the cross-border, slight wording difference in a credit support annex may lead to the disagreements of cross-border transaction. So this is quite sensitive because it's very difficult to harmonize legal framework. That's why we thought that we can start from the pledge collateral, cross-border collateral, not repo, because we don't need to step into this difficult legal topic. So through this cross-border arrangement, currently we are very much focusing on the pledged collateral transaction. Next slide, please. So the possible proposals to create the regional cross-border collateral market. Well, most of cross-border collateral and repo transaction, the USD and US Treasury. So we really need to create more awareness and the use case. Well, this is related to the difficulty in the differences in the legal framework and the market practices. And this is the biggest hurdle. For example, as I mentioned, slight difference in the legal wording or a bankruptcy procedure or recognition of local currency, or even people do not know how to liquidate those collateral. So these needs to be solved through the regional discussion, also maybe through the regional platform. That's what we need to do. And the counterparty cross-border transaction, well, we are seeing some active engagement through international banks, but still they are using the USD and US Treasury. We are hoping that the global custodian may be able to facilitate the use of cross-border arrangement. Of course, we need to promote the awareness also through the establishment of cross-border facility. We may be able to reduce the transaction cost of such transaction. So a cross-border settlement infrastructure forum is really the enabler to establish such market infrastructure. So next slide, please. So I'd like to share some of the activities under the cross-border settlement infrastructure forum. Next slide, please. So already the CSIF have produced some key documents. As I said, we are trying to create the linkage among central banks and CSDs. And under this CSIF, we agree on the basic principles, how we can establish the regional settlement intermediary. Also, we agreed on some key issues. For example, to link among all the central banks, we need to make sure the cyber security. Also, we need to agree on the BCP arrangement. And also, we issued some technical guidance. We've been promoting the standardization. So through the standardization, we can ensure the interoperability when central banks and CSDs have been linked. So next slide, please. So this is a kind of timeline. Well, the phase one, we specified the necessary requirements, user requirements, and now, then we discussed the more sort of how we can implement. As you can see, we've been discussing what would be the most possible way because we do not want to create a situation that the later comer becomes the kind of or later comer is going to be put in a kind of inferior position. We need to make sure early adopter or late comer, we need to be inclusive. So we agreed the kind of a basic framework, technical framework. Next slide, please. And implementation phase 3, we are now under this phase. And as I mentioned, next year, the BOJ and HKMA will introduce the first cross-border cross-currency DVP link. And we are hoping to create more. The next slide, please. Well, but to promote, well, we also understand that currently the cross-border transaction among ASEAN currencies is not that large. And also we see the technical advancement in this region. So we agreed for the next 2 years, we should kind of taking stocks of our experience. In Asia, we see more introduction of new technology, blockchain, and recently the Thai government bond for the retail is issued under the DOT blockchain. Also, as you know, China trying to introduce the digital currency for the central bank money. So these, the recent technological advancement need to be taken into account when we create the linkage. And this is going to be a key part. And the third part, we will also discuss the collateral eligibility for the market infrastructure. So those will be discussed for the next 2-3 years, and hopefully we can realize more cross-border collateral transaction. That is the end of my presentation. Thank you.
Thank you very much for the excellent presentation. I think there will be many questions, but let's postpone it until the end of this session. So next one is Lee Bantam from Euroclear. Your turn.
I will start to unmute myself. It will go better. So first of all, thank you for having me and to be able to also share a little bit our thoughts about collateral and collateral movement around, because the focus will really, and the previous presentation already made that move. We as a, I would say as a market infrastructure, we're really what we call ourselves the plumbers in that infrastructure and in that ecosystem. It's really making sure that the pipes are there, because indeed there's a lot of policy, macroeconomic events, policy decisions that need to be taken, and that indeed can help movement of collateral across the region or even further across the globe. But at the end of the day, the plumbery needs also to follow. And so that's really where we see our role and try to play our role in there. And it's really true, and that will become clear through collaboration with the different stakeholders in there. Because you will see the presentation is also much more a view of an approach to the problem than really coming up with, voila, that's the solution, because it can only through collaboration, because there are many things at play. So I would start with a statement of saying that indeed mobility of collateral is a key topic, but then I really focus on the technical, I would say on the plumbery movement, because the mobility is important. Why? Because contrary probably to 5, 6, 7 years ago, where there was a lot of discussion about there will be not enough collateral, I think that we see now there is sufficient collateral, but the real challenge is to get the collateral, the right collateral at the right time, at the right place. That is still, we think that's still an observation that holds, that there is sufficient collateral, although we have seen that crises like we saw early March has certainly increased the demand for collateral. One figure I recently heard is that in March, for instance, in March or in the last period with COVID, that from initial margin demand, there was an increase of 270 billion of demand due to the crisis, for instance. But statement hold, there is sufficient collateral around. It's really, the question is, how do you get access to it? Because really what we try to avoid is that collateral gets trapped somewhere, okay? And that can be for different reasons. It is at a transactional level, okay? You have a bespoke transaction with a counterparty where collateral is involved. If it is not well thought through, you can really trap that collateral for a longer term, and can potentially be not the most optimal way of using that collateral. That's at transactional level, but also at an inventory level, you need to see how you can manage well your collateral and that it is not trapped. And one of the, I would say, and that's point of discussion here, one of the biggest ways that we see collateral trapped is indeed it remains trapped in the local market. Okay, and collateral is indeed local government bonds are used in a local market, but it remains within the local community, and that's then where the whole question is: how can I unlock that collateral? Because it is probably good collateral that is acceptable for international players, but how can I then make sure that the plumbery is there to move that collateral from one country to another? And that is where, from an approach perspective, a market infrastructure in general and Euroclear more particular, is that we look at collateral management then as a really holistic play. You need to look the problem really holistically, and it starts because it is not only about collateral management. It is about how do I manage an asset that I have been buying that has a maturity that will redeem, but also in that whole life cycle of buying, selling, and all of that, I also want to use it as collateral management. And so the whole liquidity management now within banks becomes real holistic and touches all the parts of the business lines. And that's also the way that we think we need to look at that. And then it is just saying that, again, mobility then is extremely important when you look at it in that way. And when we talk about mobility, it's really making easier for collateral to move in an environment, and the environment should be easily accessible. Okay, it should be. You should have some common rules, I would say, from an accessibility perspective, from an asset protection perspective, and also from a settlement finality perspective. It should be an environment that is globally recognized and where all the stakeholders, not only locally but also globally, regionally and globally, really can find themselves in there as something that is recognized and recognizable for them. And that's global approach, okay, and I come to the word, the press has called that Euroclearability. Indeed, it is linked to Euroclear, but it's a more common, I would say, a word that is used for saying we create an environment where indeed accessibility, asset protection, settlement finality is defined along global standards. And maybe next slide, if it's the correct version. No, I think there is a, sorry for that, there is probably not the correct version of the presentation. If you can go to the next slide, I think that's, or I don't. No. Yes, what I here try to show is that from that Euroclearability perspective has shown to have an impact. Again, it is not, and I refer a little bit over, want to use Joss's disclaimer also, is saying it is not the only reason, far from, but we have some examples where we have seen that when a country collaborates, where you can collaborate with the stakeholders in a certain country to move towards creating or accepting or adapting to an environment where you define accessibility, you define asset protection, settlement finality in globally acceptable standards, that then indeed the fluidity and the liquidity of the government bonds in a cross-border environment will increase a lot, with the impacts that also have been seen by a study from PwC, where we saw a decrease in indeed the borrowing cost of these countries, not only from a sovereign perspective, but also from a corporate perspective. And in this increased, I would say, liquidity, there also, of course, collateral plays a role, and how these securities are used in collateral management play, I would say. And then maybe if we can go back to the previous slide, if that's possible. Yes. So the point that I here want to make, and I already said it, it is a collaborative approach. And creating such an environment or such a platform where cross-border movement is possible, I think market infrastructures, okay, are in general well placed. And from a Euroclear perspective, there are some points that are really, I would say, important in there. First of all, a market infrastructure is a very strongly regulated environment. Now, if I look at Euroclear in the European environment, you have CSDR, where now you have a new licensing process where you need to go through. where colleges of regulators across Europe are looking in how you're doing from a risk management perspective and how you're managing the business overall. So it is extremely well regulated and transparent to what is happening. And for Euroclear, on top of that regulated activity, Euroclear really has three main strategic drivers. One is risk reduction for the market, okay? The other one is cost and process efficiency we want to work to. And the third one is global collateral and liquidity optimization. So it is part of our strategic intent as a market infrastructure to deliver to the market that mobility of collateral in general. And so with these, on top of that, okay, as we already use the term sometimes of an ecosystem, and that is probably the uniqueness that you see in market infrastructures, is who are connected to that infrastructure. And if I look at Euroclear, we have about 2,000 connected financial stakeholders. No, you have to, not yet on that. You can go back maybe on the presentation. Sorry, yeah. No problem. You know, was you going to the? Was that the other presentation you were showing? Sorry, sorry for the technical. Okay, do you? No. No, that's not the right presentation. Sorry, this is really not the right presentation.
Hello?
Yes.
Miss
Yes.
Kim? I'm so sorry to interrupt. Miss Kim? Would you be able to upload the updated version that I sent yesterday, please?
That's the one. That's the one. Thanks, Susan.
Yes.
That's the presentation, yeah. Okay. Sorry for that, but the next slide, maybe it will be more familiar. Yes. So that was where I was explaining a little bit the key factors. And then the players, and that you see at the outer circle, it is really a place where you bring issuers and investors together to start with. Sometimes through the investment banks or the custodians or direct. And even more important is that also in such market infrastructures connect to each other. Okay, and so you have CCPs, you have CSDs connected, you have the central bank, we have over 100 central banks connected to the platform, and that's probably a unique environment where indeed you can accommodate cross-border collateral if at the start the pipes are right, I would say, and that's a little bit where, and I go to the next slide, is where we had that concept of open architecture. And if you can go to, yes, of open architecture. And that has been illustrated by, I would say, the comparison with a highway. So we call it the collateral highway. What is typical on a highway is that things move fast, and that's where we say assets and collateral needs to move fast around. But also you have, I would say, exits and entries at that highway. And before you can come on the highway, okay, there are also rules on the highway. I was talking about accessibility. For instance, you cannot with your bike come on the highway, I would say. So there are certain rules on a highway. So also in a collateral environment, I would say asset protection, there are priority rules on the highway and these type of things. So there are certain rules on the highway, but what we make sure is that there are easy entries and easy exits to the highway. And typically, I would say on the entries, you will find other market infrastructures, such as other CSDs or ICSDs. to move collateral seamlessly on the highway. And on the exits, you will find the people that want their exposures to be covered, which again can be in another CSD or at a CCP and so on. And so that's really the idea of creating that environment, which you can call the highway or the platform where you're working on with some rules that you agree, and then to make sure that you can move collateral very quickly in and out on that highway, while you on the next slide will see, while you're managing, I would say, the whole exposure management, and that is where you will try to optimize. And what is very important is at the bottom is the automated and integrated service that really comes to that holistic view, where it is not only just by one exposure that I need to cover, but it needs to fit in my trading strategies, in my overall liquidity management of an institution, and also my exposure management vis-a-vis my counterparties. And all these things need, I would say, to be very integrated and optimized to have the best uses of collateral. Because, as I said already, maybe there's no shortage, but you need to be sure that you really use the right collateral at the right place at the right moment. Okay, and so that's really where, as a Euroclear, we have been working on and collaborating already with many, I would say, other market infrastructures to make that work. What we see there is that indeed from a collateral perspective, and you go to the next slide, you see much more global usage of collateral as we cover as a global market infrastructure the different countries. We see with the combination of multi-currency settlement, but also multi-currency exposure management, is that we see quite some collateral used across the globe, also Asian collateral in certain transactions or the other way around. Okay. So if we put it to the test, and there I took a snapshot, okay, of our collateral management services that we offer, and I looked what is the type of collateral that we see used today. And so on the vertical line, you see the amount of collateral. On the vertical, you see the different countries, Asian +3 countries that have assets on the platform. And there, it has already said several times today, there is a predominance of indeed Japanese collateral used in tri-party, and that goes across exposures. It's not only for repo, it is even now mainly for securities lending, so the swaps that we see happening and all of that. Now, what do we learn here is that, first of all, is indeed the predominance of Japan collateral used currently in our system. I know it is only a snapshot and a part of the business, but it can show some indications. That's one. And on the other hand is if other countries are active on the platform, it is mostly through their international debt. So the Eurobonds that have been issued by these countries that are also used in an international environment. Now, is it because the countries that are listed there that are much smaller, is it because they are not well connected or Euroclearable, as we call it sometimes? Not necessarily, because as I said, there are, and already it was said in other presentations also, there are certainly other factors playing. One of these that we hear a lot is, of course, how acceptable is it as collateral, or certain assets as collateral. And what we see, if central banks or central counterparties start accepting certain assets, then we see indeed a big growth in the overall usage of that specific collateral, I would say. And that is where maybe I want to use as a use case a little bit South Korea, that sometimes it doesn't need a lot from a plumbery perspective, I would say, to make improvements. And if you go to the next slide, I quickly listed a little bit what are the things that, and some have been mentioned already during the presentations. What are these common rules? Yeah, the next slide. Yeah, what are the common rules that we, in a collaborative way, work on with stakeholders in certain countries, and we've done it with several countries. We have in Latin America, we already have several discussions. We have also in Europe with Poland, Russia, where you go with stakeholders and you go through this point and you say, how can we find solutions? Because we know if, for instance, you accept an omnibus account structure, it is much easier to create that mobility across different between different stakeholders. Also about finality is, of course, in settlement very, very important. And also tax procedures. Okay, countries are I would say sometimes creating tax procedures which are quite complex and for which international investors are less, I would say, interested, or it makes it less interesting for international players to become active in these assets. So that's the list that we go through and discuss and try to work with local stakeholders. And if you go to the next slide, there I use as a use case South Korea, where you see from that list, many things are already, I would say, in place or accepted. But that's a preliminary view, but that is also from history, because we had a Euroclearable link with South Korea before. But then things happened, a crisis and so on, and things were changed. And so we have now a problem from I would say somewhere a problem, I would say, where Korean collateral is seen as very good collateral. If we listen to the stakeholders on our platform, it is collateral that they are more than happy to take in many of the transactions that are happening. But there is a certain barrier still around tax procedures, which makes that less efficient, and therefore we see less activity happening on the platform, or I would say only international bonds from South Korea happening. So that's where we are really trying to reach out to local stakeholders to say, look, is that something that we can discuss about? Because we think it is a blocking factor today to have more cross-border usage of your collateral. And that is then, that I said, is in a collaborative way that we try to achieve that. We know, and that's the next and last slide, it is, of course, as I said, a collaborative effort. It is certain decisions that need to be taken by these stakeholders from a policy level, some laws and so on. We also know that there is one important factor, and especially if you open up your market, is the danger of hot money, or very volatile, a more volatile environment, that you create a more volatile environment. And that is where transparency comes a discussion which is regularly on the table, because it is seen that these solutions are not necessarily creating the necessarily transparency about who is holding the securities, who are the investors who are using these securities. And these are now, through innovation and technology, aspects that we can cover. And so to give recent examples, in Malaysia, for instance, we now give a full Euroclearable link, and we give full transparency to authorities about who is holding and so on. Also in new developments that in the near future we will see on China, there we also, with what we will call the Yuan bonds, we will also see increased transparency, I would say, given to regulators given to the authorities to make things much more smoother, and that it is acceptable from their end also to go into a much more, I would say, in an omnibus structure, which makes things more efficient from a cross-border perspective. Voilà, that's a little bit what I wanted to share in the context of trying as plumbers in the industry to increase cross-border settlement. It is really going in a collaborative effort with local authorities to connect and to create interoperability, what was mentioned before also, but that in a standardized, very resilient and also sustainable way going forward. Thank you.
Thank you for the nice presentation. Especially, I like the highway analogy. This is
yeah.
So we have all the potential players. I mean, they have all the resources and this experience to make this happen. But I think, well, we'll talk about the governance issue later. But I think this is a Q&A session for the first presentation. And do you have any questions? Can I ask any questions for the past 4 presentations? I think, Mamuan, you don't have any?
Yes, I have. Yes, I have. Can I ask? Okay, I don't know if Professor Nyborg has gone to bed. It must be a very... Is Professor Nyborg still there? Hello?
I am. I'm here.
Okay. Oh, he's still awake. Yes.
Pulling an all-nighter.
It is a very odd time, but thank you for staying. So I liked your collateral framework honesty very much. I've seen so much on collateral frameworks, which is so much lipstick that that this was very, very much a breath of fresh air. I would like to add something. You gave a number 200, 300 billion, thanks to rating agencies like DBRS, etc. Otherwise, the collateral needs to be much higher, but the pricing is being subsidized because of certain countries in the south. May I also add that around 2004, 2005, there were many interest rate swaps, which the sovereigns, most Eurozone sovereigns have taken, and they are now all out of the money. But as you know, the rules of derivatives do not require sovereigns to post collateral. They can be exempt. So much of the Eurozone countries out of the money, there is a similar number, like you mentioned, 200 billion, which will be due. If you look at a 30-year rate swap, a 2005 interest rate swap will only be due in 2035. So we are halfway there. And given that the rate environment is still near zero, this number is only going to go up. So when people mention that there is not much need for collateral, or there's collateral, there's no shortage, I would like to add that there's a lot of collateral not being put in place, and also much of the rules and regulations have been postponed. For example, the CCP clearing has postponed a lot of, so the collateral requirements are still there. If you even look at recently what's happening to the bonds, you can do APP, but at the end of the day, you're also taking in bonds, and then you force them to the SEC lending program to come back to the market. So I just wanted to put things in perspective after, and I have one more question. I liked a lot what Mr. Tomo Yamadera mentioned, and I think this issue about interoperability between central banks and the ICSDs, I mean, that is the magic bullet. And I think even if you start with the small pipes like HKMA, BOG, that's okay. You may not get all the pipes, but bilateral pipes are very important. Thank you.
Any other questions?
So let me just say, I found what you said, Maman, about the swaps extremely interesting. Maybe you could send me the references for where I can read about it.
Okay. Okay.
Thanks.
I think I have a question to Professor Nyborg. If I still remember well, then on European collateral framework, many collaterals are illiquid. That's what your slide suggests, and I'm wondering why.
They are. I think in the fixed income space, there are just a lot of securities that end up very quickly with the end users. They just simply don't trade. I mean, here we are looking at 30 to 40,000 different ISINs, and that's on the public list. There's also more securities that are not on the public list. We don't know how many there are, but 30 to 40,000 different securities is a huge number of securities, particularly if you come from, let's say, the equity space. We don't have that kind of number of securities listed on many exchanges. And I think equities are by and large more liquid than most fixed income securities and central government bonds accepted.
And Professor Debo, I think you mentioned about the problems with accommodative collateral framework. I think it should be distinguished with the inclusive collateral framework, because I mean, there are problems with accommodation. I mean, if they don't have any market transactions, then maybe it will lead to some problem. But we are talking about inclusive collateral, because we are excluding this eligible collateral from the possible collateral framework, and there may be a serious problem also. So, I mean, we have to distinguish between accommodative and inclusiveness of collateral framework.
Yeah, I think that's a good point, and I think there's a point where inclusivity also becomes accommodation. But of course, in a system such as cross-border system, Euro system, you need different countries to have collateral that is needed. So in the early days, I mean, the Euro system collateral framework is essentially built on the old Bundesbank system. And that was built on the back of Pfandbrief, covered bonds. And not all countries in the Euro area had that kind of system. And so therefore, initially they had a two-tier system where you had one kind of common set of eligible collateral and a second tier of collateral that was more particular to individual countries. I mean, one could put it that way. And so for that reason, they also allowed equities in the early days as a form of inclusivity, if you may. But I think the line between accommodation and inclusivity is fine. And you have this notion that you want to channel liquidity where it is needed, and one way to do that is to be very inclusive. But on the other hand, when you do that, you also you work against market forces. So from a central bank's perspective, I think they should get the liquidity out of the system, and then market forces in the system should then reallocate it. If you're too accommodative / inclusive, you also will lose the signals from the market.
Okay, Professor Naibo, I have a question. During your presentation, you mentioned time in constant policy of a European Central Bank collateral framework. I found it very interesting. That implies there is no different treatment of each sovereign government bond as a collateral from the viewpoint of European Central Bank, but there are, on the other hand, there are differential treatment in the market. Given that situation, there is some arbitrage opportunity from market players to European Central Bank, for instance, by delivering sort of cheaper government bond, for say Italian government bond or some Spanish government to deliver, to fund from the European Central Bank, utilizing to the market. By doing so, there is some arbitrage opportunity. Is that true? Is it possible?
Well, I think you have a situation like in so many other arenas in finance, like in futures. You want to deliver the cheapest that you can. and I also know this, that the collateral is being, the people, the players that create collateral, created with an eye towards the collateral framework. And some collateral is created to suit the collateral framework rather than the market. So that is to be used vis-a-vis the central bank, and then other collateral is created to be used in the market. And that's not necessarily a healthy thing.
Could I ask a question?
Please,
Of,
go ahead.
Yamadura-san, you emphasized in the ASEAN +3 framework bilateral arrangements. You did not seem to emphasize the prospects for an Asian ICSD or for Asian countries to use Euroclear. So do you think there is a prospect for an ICSD, a multi-currency ICSD in Asia on the same time zone? Or do you think bilateral arrangements between central banks is the best way to go? Or do you think that Asian countries should try to establish links between their own CSDs and Euroclear? Which of these three routes is, do you think, the best?
Thank you. Thank you for the question. Actually, that question was already discussed in a previous regional fora. Well, 2010, a group of experts published the report which examined the business cases for the CSD linkages and Asian Clear. And it was a clear preference among the ASEAN +3 to go for the CSD linkage, the network. But after the central bank came in, because only the CSD linkage cannot ensure the DVP, only the securities part. So together with the central bank and the CSDs, they agreed to create the linkage. This solution is preferred because, as I mentioned, Asian currencies and bonds are not allowed to settle in offshore. I mean, there's strong preference of central banks to maintain the controllability, and it is quite difficult to bring those currencies settlement offshore. That's why we see the non-deliverable forward market, which is the cross-currency swap, but it's denominated in USD, settled in USD, and so that's one of the difficulty. We need to understand the preference, the concern. The Asian countries tend to feel that they are small open economy, so they are vulnerable to large inflows and outflows. So another way that we are approaching is how we can increase the market transparency so that how we can alleviate their concerns. So we may be able to see some sort of relaxation of those FX regulation. That's another initiative that we are taking.
Thank you. That's very, very helpful. I appreciate that.
Are there any questions? I think I really like the idea of the Pan-Asian Collateral Forum. Huh?
I was sorry. I just wanted to emphasize or to amplify a little bit the discussion. I can, on any discussion we have with local stakeholders, and especially in Asia, transparency is at the center of the discussion. That's what we see now when we have this discussion. And it is not it's an interesting discussion, but not a discussion that seems impossible to come to an agreement, which we have already with some countries. But indeed, it remains a major point of discussion to create that transparency, because it's indeed the fear, but it's I would say the economic reality, of course, that indeed what investment is coming, it can quickly go away, and that the stakeholders want to control that. That's for sure.
Yeah. I like Josh's idea about this Pan-Asian collateral basket, and I think to make it happen, I think we need not just collaboration, we need some kind of what is that? The third party kind of an individual institution can actually promote this idea further, because we have a fragmentation and segmentation among Asian nations in terms of decision making. And this is very complex governance issues. And so, I mean, to make these things happen, we need a special institution promoting this idea further. It seems like at the top level, we need some kind of agreement that this is something we have to do. And for that, we need to communicate with higher level officials that this is something we are missing out. So I think Euroclear provides some crucial function in this field, because they have all the expertise and the capability. So we can start to make this plan more concrete, so that we can persuade, we can resonate with a lot of stakeholders in the region. Otherwise, this bilateral arrangement stuff and all this harmonization, all this stuff, all these efforts, it's serious hindrances actually going forward. So, I mean, especially HKMA, BOJ agreement, that's a good achievement, a very remarkable achievement. But I mean, things are moving fast in this area, and we need to really collaborate in a realistic sense. And for that, we need a special institution, some kind of out-of-the-box solution to this problem. So I think Josh can help us come up with some kind of more concrete, appealing plan to move this very heavy project going forward. And if you don't have any questions, we'll stop for a moment for coffee break, and we'll come back with panel discussions. Thank you.
Question for you, I'm going to send you a chat.
Okay.
Okay, thanks.
But because of the time constraint, they already gone.
Okay.
Huh?
What is the difference between Q&A and panel discussion? I think it is the same.
No, it's different. So Professor Kim will preside over
디자인을 할 것도 없고 이 사람들 자기네들이 이거
Sunny, thank you. Thank you for participating.
Thank you, Mr. Choi.
Nice to. I mean, you were mentioning we need something like China Connect, something like Stack Connect, something like that. I wish you to strike some deal with Korea.
Yeah, sure. Yeah, I think we've been focusing on Korea for quite some time, and now I think we have a good amount of success in Korea. So, and now we're shifting to China. But of course, as in looking at the growth plan in Korea, we're seeing Korean collateral being acceptable now more and more as international collateral. So a lot of demand from the broker dealers.
Yeah. So make it happen and get promotion.
Yes. Relying on you, Mr. Choi.
I do my best.
All right, we have a panel discussion. We have 4 discussants. Dr. Manmohan Singh and Professor Daryl Duffy.
Yes.
One is your turn.
Okay. Looks like I was on mute. Okay. Thank you, Dr. Choi and APCF for giving me the opportunity. I probably have 5 minutes, so let me do what I can. You know, we have been hearing about the global pipes, the global plumbing. Let me give you a picture of what these pipes are. I've been following this from 2007, so these are not easy numbers to get. You got to read the annual reports of the larger banks who are active in the pledged collateral market. I'm trying to emphasize the word pledged collateral because once this collateral goes with title transfer, it is reusable. So if you look at the major players in the US, you know, Bear Stearns, Lehman, they're gone now, but JP Morgan is very big, is north of 1 trillion. If you look at the left axis, that's billions of US dollars. So 1,000 is 1 trillion. JP Morgan is close to 1.3 trillion market. There are many others around very close to 1 trillion. But these are the global pipes and these are the players who can peddle collateral from one place to the other. You can pick it up in Hong Kong from a hedge fund, book it out of London, and a pension fund in Chile could use it. Just to show you that US banks are not the only one. And we have the next slide, please. So the non-US banks are also active. In fact, you know, a lot of this is booked off balance sheet. So except for the first transaction, if you can do the netting and it is allowed under Basel III, if it's done cleanly, a lot of this can be off balance sheet. In fact, most of these numbers I pick up is off balance sheet. And some of these numbers are even larger than the balance sheet. If you look at Nomura right now, those numbers they peddle are as large as a balance sheet. And the previous slide, Lehman was as big as their balance sheet. If you look at the major players, UBS has changed. Some of the other new entrants are the Canadian banks. The ones on the very right, they were able to get some market share as the Dodd-Frank and Basel III constrained the dealer balance sheets in the US. HSBC Nomura has also picked up. So this is just a sense of the pipes, and these pipes are not small. If you add all these numbers today, if you looked at the most recent number, it's about 8.5 trillion worth of collateral they're moving around. If you look at what they did in 2007, it was about 10 trillion. So yes, there is some compression of the balance sheets. There's some compression that the pipes are not as freely available because it's very difficult to have the balance sheet space, which was more free ex ante Lehman. And that free space comes with a cost. So now every transaction have to contribute towards the profit per unit of balance sheet. That's why certain transactions don't take place. Most of this collateral comes from either repo, sec lending, prime brokerage, or the derivative margins. So they are linked to the Global Master Repo Agreement, Global Master Sec Lending, prime brokerage, and the ISDA agreements. Now, the market last year in the US, September 2019, many did not want to come into the repo market. This year in March, many did not want to take the off-the-run treasuries because of G-SIB scores. So balance sheet constraint is really there. So when we say that collateral is available, yes, but the pipes are not as big, or to go into the pipe, there's a cost. And that is very important. That's why custodians have to step in. I really like this ICSD thinking, which some of the panelists will follow. But this is why, even if collateral is available, the pipes have some restriction now, which was not there before Lehman. Last slide, please. Okay. So what I'm trying to get at is there's a near zero rate interest environment for the next 2-3 years. Most central banks are not going to increase rates for a couple of years. Now, we already heard from Yamadera-san about the Hong Kong and the HKMA and the BOG experiment. I think it's a very healthy pipe if it works. Basically, there's demand for JJBs in Hong Kong accounts, and similarly, Hong Kong dollars, it is still a good peg, has demand in Tokyo accounts. So there could be a bilateral pipe. Obviously, a multilateral pipe will be much better to jumpstart a pan-Asian market, but bilateral pipes is also a good start. As you see, Singapore today has, the Singapore collateral is acceptable in LCH, just like the BTPs of Italy have access to LCH thanks to the Eurozone plumbing. So you need to start. And if these are pipes, then maybe down the road, the pipes can get they may be interoperable. There was a recent transaction, which I'm sure Bhavna will talk about later. This way, the Hong Kong-China Connect, that you don't have to face China clear. This is also a bilateral pipe. Some may argue Hong Kong is part of China, and yes, that's true. But a bilateral pipe is in place, so the foreign investors don't have to look at the domestic side. That's a China clear. In general, my point is that emerging market collateral is not yet pledgeable and reused in those international pipes. Those pipes are big. They are, as like Professor Nyberg linked money and collateral. You know, the broad measure of money and these pledge collateral numbers are very similar. So these are lubrication. When you talk about liquidity and lubrication, you cannot just look at money numbers. You got to look at money and these pledge collateral numbers. These are slightly different than tri-party, where you may or may not get reusability. But at least if the pipes are made, the ICSDs can be the next step after this. So my main point is there's very good collateral in the region, Asia. There's also some good collateral in other parts of the world. Eastern Europe has some good pockets. Mexico comes to mind. They have all come close to this issue, and the custodian issue comes up. Some of the local tax issue comes up. But if they can get a slice into this market, because there's a zero rate environment, most people are not getting yield. Most of them are just getting 2 coupons a year. Can they do better? Of course, if you look at some of the central banks in the Eurozone who are sec lending bonds, you really augment even a negative yielding bond. You can augment a lot through the sec lending market. And so that's my point, that maybe use a zero rate environment where everyone is yield hungry to maybe get something more than just the yield and the coupons from the emerging market bonds. And this should be an incentive, even if it's a bilateral pipe. Thank you.
Thank you very much. And move to Professor Duffy.
Thank you much. Thank you so much, Professor Choi and Dr. Kim. I really appreciate the chance to be here. This is my first visit to your forum, and I'm learning a lot, actually. And my main reason to be here is to learn about what's going on in Asia with respect to collateral pledgeability. I prepared some remarks on observations about access to US dollar liquidity for banks in Asia during stress periods, because this is a focus of my own research. So I just want to spend a couple of minutes talking about this about the role of central bank swap lines, foreign central bank repo pools, and the role of ICSDs. So the idea is that in periods such as March of this year, access to funding in US dollars becomes very stressed. And we saw signs of that in elevated cross-currency basis. And even in US dollar repo markets, there was elevated funding costs. Central bank swap lines, as everybody knows, can alleviate these problems by making US dollars available to foreign central banks, which can on-lend those dollars to their local commercial banks. And in the March period, the Fed used its swap lines with, or at least made available swap lines with its 5 typical counterparties, but also opened up to additional counterparties, 9 more. And those in Asia that used them were Singapore first. And then I just discovered earlier today that the Bank of Korea also used some swap line access, although not in March. My question earlier to Professor Choi and Dr. Kim was about what happened in March. The cross-currency basis in Korea, the won dollar basis was quite elevated, and the Bank of Korea did eventually provide some swap line, dollar swap line funding to its banks, but it didn't draw on those lines initially in March. And I'm still curious about why that may be. Another way that the Fed has supplied liquidity to foreign central banks is by allowing them to pledge their US treasuries to the Fed in a repo transaction for which they get dollar cash. The Fed likes that because that means that the foreign central banks do not need to liquidate their treasuries in the cash securities market. And anyone that watched the US Treasury market in March of this year saw what a mess that was, as so many actors attempted to liquidate their US Treasuries. So much so that the US Treasury market, believe it or not, became essentially dysfunctional. And that dysfunction was only relieved eventually by the actions of the Fed buying $1 trillion of treasuries in only 3 weeks to take these treasuries out of the market. And the US Treasury market needs a new design. That's a different story. So the foreign repo pools, foreign central bank repo pools were quite an efficient tool for foreign central banks to get dollars without necessarily liquidating treasuries. According to remarks made here at Stanford University by Vice Chair Randall Quarles of the Federal Reserve System, the largest liquidators of US treasuries were the foreign official sector, in his words, which I take to mean largely foreign central banks. I'm not sure how much of that was for foreign exchange management and how much of that was to provide dollar lending to local commercial banks. I suspect some of each. What I would like to do in just the remaining couple of minutes is to talk a little bit about the role of ICSDs and about cheapest sources of funding when under stress. I should emphasize that thank you. I should emphasize that China already has foreign central bank swap lines with many countries, I think about 25 or 30 countries, but these are not for funding stress or providing liquidity. These are to encourage the use of the RMB in international trade transactions. What the Fed is doing in stress periods is quite different. So this diagram illustrates an abstract ICSD indicated in the background with some dollar and RMB assets pledgeable and some not pledgeable. And when a commercial bank in a particular currency zone, let's say an RMB currency zone, wants to obtain dollar funding, in principle, they would pledge their assets to an accessible ICSD and obtain dollar funding from a counterparty that can provide funding and hold the pledged collateral at the ICSD. The problem, of course, as we've discussed this evening, is that in Asia, there's limited access to ICSDs. Yamadura-san spoke about the opportunity for bilateral pledgeability between yen assets and Hong Kong assets through their respective central banks in a bilateral arrangement that serves the same function as an ICSD. We also have pledgeability through Bond Connect in principle between the currency monetary unit, the CMU of the Hong Kong Monetary Authority and the China Central Securities Depository or the Shanghai Clearinghouse. And that increases cross-border multi-currency pledgeability, but these are narrow bi-currency, two-currency arrangements. And my line of questions earlier today to your Madara-san is if it's possible to get a wider range of pledgeability. And now I understand better from his answer that this will rely in part on the ability of some countries to allow their domestic banks to pledge offshore to do offshore transactions, which is related to capital controls. So this is an issue. In principle, unsecured funding can get so expensive that banks would be willing to pay the penalty rate at the central bank swap line to get secured US dollar funding directly from the People's Bank of China, except that it's a political reality, given where US-China relations are, that this is just not going to happen. In my view, it would be great if the People's Bank of China and the Fed were at a state of international affairs at which they could establish swap lines with each other, but that's not going to happen. So this is maybe for the distant future. In the meantime, there's still an issue of, as everyone has discussed tonight, mobilizing collateral so as to obtain funding. And again, my focus is on stress periods. Next slide, please. This is my last slide. I just want to mention the calculation that a local currency bank is going through when it's deciding how it can get dollar funding or get foreign currency funding, whatever the currency. And the idea is that it could go to a central bank swap line if one were available, and it would pay the blended rate, which depends on the haircut for the central bank swap line. And the swap line rate, called RS in this illustration, that's blended with the unsecured funding rate, because if you're going to get a haircut, then you have to get the rest of the funding via haircut, via unsecured markets. And the whole point of a central bank swap line is that unsecured funding can be very expensive. That's exactly why the swap lines are needed. The alternative is to go into another source of private market funding and look at the available haircuts and secured and unsecured borrowing rates, and pick the best of the two. And if there's a blend, you may actually get some of each, depending on the amount of pledgeable, amount of space available. Currently, for example, in the Fed swap lines, the only central bank that's actually activated its swap line currently is the Swiss National Bank. And why is that? Well, that is because the haircut that the Swiss National Bank applies for access to dollars through the Swiss National Bank's swap line with the Fed, that haircut is 0, which means that it's an attractive source of funding. If you pick the European Central Bank as an alternative, the haircut for dollar assets or assets pledged in order to get dollars from the ECB is 12%. So nobody is drawing funding from the ECB swap line, even though it exists in principle at this point. These swap lines are at penalty rates. Remember, 25 basis points. It was dropped to 25 basis points during stress. But even at 25 basis points penalty or higher penalties in non-stress periods, you will draw on them if the haircuts are sufficiently attractive and not otherwise. So these are the calculations that banks go through. And I just want to summarize by saying, in Asia, it would be fantastic if there were a wider range of places to pledge collateral at moderate haircuts, especially during stress periods. And currently that seems to be an issue. And I'm just waiting for all of you guys to solve that problem. And it sounds like you're making great progress from what I heard from Yamadura-san. This is an ongoing project with many participants that are working on it. And I hope next year there will be a progress report showing more progress. So thanks very much.
Right. Thank you very much. Now, please, Vice President.
Yes, thank you, Mr. Choi, and thank you everyone here. I'm sure it's getting late for you guys, but I won't keep you guys waiting. But just I'll start off by giving an insight or a theme which is prevalent across our broker dealers or the banks are broker. We've seen, as you've already highlighted, I think earlier Josh was highlighting that with the regulatory pressures which are on right now, the focus for the broker dealers has been how to create efficiencies. And this theme of creating efficiency is going to continue in the next 2-3 years. What we see is that the banks are trying to either reduce friction in the currently mobilized assets or trying to mobilize the assets which are immobile. So there is a lot of focus on asset mobilization. Earlier, we expected, okay, if you have some assets which you're long on your balance sheet, it was acceptable for them to lie idly on the balance sheet. But recently, it has been stated throughout the banks and broker dealers that if they are trading a particular assets or if it's on their balance sheet, there has to be a mechanism to finance or mobilize the assets. So a lot of clients are using either the bilateral way or the tri-party way to mobilize the assets. And one of the ways to promote asset mobilization has been centralization of the collateral trading desk. So what we've seen earlier traditionally that collateral was used for securities lending and for repo trades, but recently with the uncleared margin rules, we've seen cleared and uncleared derivative trades, which are now in scope for posting collateral. So with more and more desks which are coming into the picture, which need to be the users of collateral, there has been a significant trend towards consolidating these desks and centralizing not only the desks, but also the asset classes. So there's now most of the top 70% of the tier 1 banks have these centralized collateral trading desks, which are across the asset classes. That means for fixed income and equities, and across the 5 different desks, whether it's repo, SPL, CCP, cleared derivatives, uncleared derivatives margins. So there's been a lot of consolidation, and the dealers or the clients have seen benefits which they didn't expect it in terms of they've had much better view into their inventory now. They're able to understand what if they're long GGB in one of the desks and short in the other desk, how they can basically get more value by netting the balance sheet requirements of collateral. In terms of operational efficiency, also, there's been a lot of advantages, and definitely liquidity has improved by centralizing the different desks. So collateral mobilization is a core part of our ongoing dialogue coming from a tri-party agent perspective. And we are also keeping up with the theme of how we can give them the maximum benefits. So in terms of having a centralized collateral platform, which will allow them to move collateral 23.5 hours a day, 5 days a week. So it's an interoperable platform which moves on book entry movements. So basically, the collateral can get allocated without any dependency of local market settlement timeline. Also, reuse is a big theme across the tri-party agents, how through transfer of title you can increase the reuse, and how we can build better optimization tools for the clients to support their needs. Now coming to, this is the general, provided a general theme around where the market is, and shifting our attention to Asia, emerging market, what we're speaking about here. I think Josh already highlighted pretty well in his slide in terms of the global bond market, which we see at around $104 trillion, with Japan at the second place of $13 trillion, and I think China is at $12 billion. So we see that Asia contributes to 25% of the global bond market share. But if you see that the repo market is hardly 7% of the global market share. And we all know that the bond market is integral to repo financing and providing the liquidity. So definitely, we see there is a massive untapped potential for repo financing in Asia market. Just looking at bonds being 25% of the global market share, but the repos are just 5%. So it's just a fraction, and there's a lot of work which we need to do in Asia to untap and bring the liquidity in the market. Some of the challenges, again, I wanted to just focus on, they have been illustrated earlier, but from our perspective, we see three main challenges. As Yamadara-san mentioned, the top one is definitely the legal documentation. There's lack of standardized legal documentation, which really needs to be worked upon. We recently saw that in 2019, the ISLA pledge documentation was released, which has been welcomed by the clients in the market, and it's been picked up quite a bit in the West. We need to see those global documentation being adopted here, because in Asia, again, it's with the different regulations and the countries which come into the picture. With the regulatory framework is the legal framework needs to be compliant with the local regulation, and there's also required to have enforceable requirements which vary from every country to protect the rights of the provider and the receiver. So I think having a simplified process or a standardized process of legal agreements would definitely streamline or bring liquidity into this APAC repo markets. The second one, which is the market liquidity, which is an issue, again, which was highlighted earlier, that foreign investors have restriction to access the local onshore asset owners. So if local banks or domestic institutions who are largest holders of these local government bonds, they're allowed to finance assets with offshore investors, I think there's significant potential for both offshore investor and onshore dealer to generate additional yield. So definitely looking for more cross-border arrangements in APAC in the coming future. And also the third one to highlight is market infrastructure. There have been issues with the fragmented system, settlement system, which lead to higher costs, operational risk, and inefficient settlement. So I guess it is definitely to overcome the challenges. I think if regulators and depository can encourage linkage to whether it's ICSD or the global triparty providers, then it will be a significant boost for the foreign investor participants. I think looking at APAC, I think triparty agents are at the same level playing field as the ICSDs. And with respect to the connectivity, both ICSD and triparty agents can play a significant role in terms of providing the harmonization and standardization across the repo markets. And we've seen it in the past in terms of its time-tested solution with the Lehman default, how triparty agents were there in terms of providing the governance and allowing the movement of collateral to the non-defaulting party. So the structure and the framework and the risk governance is all in place through utilizing either ICSTs or tri-party agents. So definitely looking forward for more work around this region. As mentioned earlier, that yes, we did, from JP Morgan perspective, we went live with China Stock Connect, utilizing China Stock Connect assets as collateral through the tri-party platform. We've seen a lot of optimization, a lot of optimism in China market lately. The CSI 300 index has climbed 17% this year, which is the second highest growth amongst the largest, amongst all the major indices. And right now, the China market cap is at $10 trillion, which is primarily being supported by the foreign institutional investment. And we expect to grow this market cap valuation again in 2021. The global investors are definitely lured by the China's economic recovery from coronavirus, and they see China is one of the least correlated markets to US. So China is continuing their focus on liberalizing all the inbound access, and the foreign investors are enjoying their increased investment in the region. Now, why these numbers are important is basically that right now we see that the foreign institutional investors are holding 8% of the current market cap, and it is predicted that it's going to go to 25%. So 8% to 25% is expected growth in the next 5 years, which is quite a bold prediction, but it's not impossible looking at the growth and interest in the market. Now, Stock Connect went live, the market went live in 2014. It's only until recently we were able to devise and get our broker dealers ready in terms of financing it. Again, it's a very unique market, but in terms of some of the rules which are in place, one of the rules which is particularly in focus and is the non-trade transfer rule, which basically prohibits any off-exchange movement of assets. So this just to ensure that we as a tri-party agent are in compliance of this rule, we could not really operate under a transfer of title model, and we had to adopt a pledge model, which has now been accepted more widely through the clients and broker-dealers. In addition to this, because of this rule, non-trade transfer rule, the event of default scenario had to be different from a standard tri-party solution, where for Stock Connect we need to utilize a liquidation broker who would, in case of a default scenario, move the cash proceeds to the non-defaulting party. So these were some of the nuances which we addressed in the Stock Connect model. And currently, we are also working on the onshore Chinese government bond access for segregated IM purpose. There are again specific hurdles around the enforcement scenario, which we are looking to work around and understand how the repatriation of cash can actually take place from onshore to offshore foreign investors. That's it from my side. I look forward to address any questions going forward.
All right, thank you very much. Dr. Im. First of all, I would like to thank you, all of your presentation, for educating me the role of collateral based on government bonds. Based on the interpretation, my own interpretation of your presentation, I would like to emphasize my own perspective. Regarding the Professor's Repo presentation, you discussed the European perspective of central bank collateral framework, assuming that there is a single currency based on different sovereignties, no capital control. According to this one, European Central Bank collateral provide some sort of liquidity in the regional area. But to achieve this framework, European monetary system has developed toward a single currency and European collateral framework. According to our own Asian situation, I would like to say that our current system would be like the second stage of a European monetary system up to 1973, which was characterized by capital control of some countries. To moving toward the European Monetary Union, first, European member country introduced some commitment of carry out some regional financial stability by fixing each member's exchange rate and then abolishing capital control and introducing new currency, which is euro, then implemented collateral operations. But as you know, in Asia, there is no common ground. I mean, in terms of no commitment device to carry out financial stability in Asia, even though we have some Asia monetary initiative, but initiative is different from European EMCF like a fund. EMCF has a strong commitment, whereas Asian initiative has some sort of promising framework, but no teeth to carry out. Also, each country has a capital control and FX control. Given that situations, I don't think European collateral framework is not applicable directly to the Asian central bank collateral framework. There are some exceptions. For instance, Japan and Hong Kong has a full compatibility in the sense there might be some bilateral collateral between two countries. But if Bank of Japan has some bilateral collateral framework with some Thailand, but there is a asymmetrical bilateral framework. Thai baht is not provided by the Bank of Japan. If some commercial bank in Thailand enters in Japan market, providing its Thailand government bond collateral in Thailand. As far as now, Mr. Yamadara offered a symmetrical bilateral framework, collateral framework between Bank of Japan and Bank of Thailand. So given these situations, in Asia, there is a strong separation between domestic use of collateral and the international use of collateral. This can be justified by the Asian central bank's strong concern about some adverse consequences of the capital reversal or capital influence. So they're going to abolish this kind of concerns to provide collective Asian collateral framework. Given this, what is the best way? What is the feasible way to introduce in segmented and controlled Asian framework? I suggest a way to resolve this kind of problem and maintain some sort of the facilitate the international use of Asian collateral framework, because domestically Asian government bonds are regarded as very safe, but internationally it is regarded as such a safe because I believe there's some control problems. So to overcome this problem, I suggest what Mr. Yamadashi suggests is kind of a collateral framework on central banks as a very limited version. I mean, each central bank provides some custodian services for each country's government bond. In that case, we don't need some international IEC SMD because each country has its own CSM custodian service depository. Using that, each country, each central bank provides some custodian services. Then we can collaborate some Asian collateral framework. That is one way of providing regional financial stability while maintaining capital control regime. So, but what is the benefit of a cost of when central bank provides some custodian service? There are some benefits. First of all, each financial institution wants to go over to make for overseas investment. But as we know, there is some long-term currency swap market in Asian market, except for Japan and several countries. So we have a large cost-funding problem given current situation. If we use some custodian service, we can lower funding costs, overseas funding costs. Second benefit is that there is some equivalence of cross-border collateral market and cross-currency swap market. In terms of risk consideration is equivalent. Funding and market funding risk involved, but there is no some market price risk and counterparty risk. Those risks can be minimized using this kind of situation. But there are some other cost consideration involved in the operation of cross-currency swap facility by central bank. There might be interrupted domestic liquidity market operation because there is some foreign currency generated government bond collateral can be used in the domestic operation. So if there is this going to be some conflict between domestic operation and foreign operation. But given considering this kind of situation, we can provide a better collateral framework than in the current situations. This is my proposal. Okay, thanks.
All right, thank you very much, Dr. Im. This time I would like to invite some questions and comments from the floor.
I have a question about time zones. The Hong Kong Stock Exchange, when proposing an Asian ICSD, said that an advantage is that there is greater counterparty risk associated with delayed settlement in an international PSD that's located in faraway time zones like Europe. So is it really true that having delayed settlement and the associated counterparty risk is a significant disadvantage to clearing in Europe or not?
Okay, I think that there should be, the question should maybe answered by Haswani.
Well, already this is
Sorry, is this related to the Hong Kong Stock Connect or?
Yeah.
No, it's a proposal by Hong Kong Stock Exchange to have an Asian ICSD as opposed to clearing at, let's say, Euroclear or in Europe because of the difference in time zones. And the Hong Kong Stock Exchange says that because of delayed settlement, there's more counterparty risk. And I'm wondering whether that's realistic or not.
I guess.
Yours.
Go ahead. Sorry.
No, but Fab, we need to see on what markets are transacting. So there's a lot of T+2, T+3 transactions ongoing. So from a settlement timing perspective, it doesn't make that difference, I think, from a risk perspective.
May I jump in? Okay. Well, I think the Luke comment was quite valid. In this region, of course, the most of the cross-border transaction is certainly T+2. So so far, okay. But if we see more increase in transaction in the intra-regional transaction, and because of settlement process go through the U.S. custodian banks and go through some transaction needs to go through the USD and become T+2, this may create a legitimate concern to settlement, and that's why that we try to bring CSDLT just linkage, and hopefully we can support the cross-currency cross-border DVP through this linkage. It's not easy to estimate the size because unfortunately inter-regional portfolio investment is about 20% share. It's not that large comparing to the intra-regional trade. Intra-regional trade is over 50%, close to 60%. And so comparing to the trade, portfolio cross-border intra-regional portfolio investment is at this point still limited. I have to say that the Asian savings are moving to US and Europe and coming back. So how we can sort of increase intra-regional mobilization of saving is one of the topics that ABMI needs to tackle. If I may, I'd like to make a few comments. Well, I very much appreciate all your comments that you are interested in. I mean, many people highlighted the CSDLT just linkage. This is kind of outcome of the regional discussion. As we all understand that each jurisdiction also, many jurisdiction has its own legal framework and differences, and it's not easy to overcome. Well, I personally feel I'm not optimistic at all to harmonize legal framework, but this cross-border linkage enable us to link the market without changing the legal framework. I mean, harmonize the framework because this is the pledge. Of course, the parties accepting the securities on the counterpart need to accept the bankruptcy resolution, also how to liquidate those collateral. But as long as we can establish the common understanding, this pledge of collateral system can work. And once we become more comfortable making those pledge collateral, then we can gradually create some sort of regional repo market. So this is a kind of ongoing process, one by one, step by step. Under the other forum called the ASEAN +3 Bond Market Forum, which I explained that this forum plays as a kind of a platform. The next year, we will also start conducting some comparative analysis of the capital market law. Because we've been collecting various legal information, and so far we have a good understanding how each market functions and what are the legal obstacles are, not only for the repo and collateral transaction, but for the cross-border bond transaction in general. So hopefully we can create the market stepwisely. Also, well, the importance of cross-border linkage is we can start from relatively low-cost implementation. As I mentioned, we will look into the new technologies. I'm hoping that the tokenization can support this cross-border infrastructure platform with a relatively low cost implementation. So hopefully we can come up with some sort of technological proposal in 2 years' time, how this region can be linked with the new technology. That's my comment. Thanks.
I think, as probably Togo knows about this, there is a proposal for Asia common currency, digital common currency, actually. And if we can be serious about this common currency proposal, which is digital, we can actually eliminate all these barriers, existing barriers, and we can set up some kind of new regulations presiding over these cross-border transactions. So it's like starting something from the very beginning, actually. So instead of tackling these legacy issues, which is very challenging for many of us, actually, wouldn't it be possible to think about some alternative based on digital strategy, like tokenization, etc., and we can come up with some kind of new regulations, which of course is harmonized from the very beginning, actually. So, I mean, isn't it time to think about the alternative as well as pursuing existing venue? I mean, these are the questions that still remains to be discussed. Okay. So, if you don't, I think the time is almost, we are almost there, and I will just briefly comment on the final remark, actually. So Asia faces tough challenges ahead in dollar funding market. It is increased dysfunctions and these deficiencies in mobilizing its collateral resources due to its limited cross-border pledgeability. ABMI task forces, including APCF, CSIF, and AMBF, Bond Market Forum, all strive to fix this problem, and we need to gain extra tractions from wider engagement and a stronger commitment by legacy institutions and players. Thanks to all the participation and the encouragement of world-class experts, we hope to get closer to reality where Asia can contribute to the global financial stability. With that higher note, let us get together in the near future in a COVID-free world. Thank you.
All right, and on the questions that Dr. Duffy brought, I'll get back to you after I figure it out. All right, thank you very much. I think that's
okay.
all. Yeah, and anything else to say? Dr. Shin, anything to say?
We have more questions than answers right now.
All right, I think that is about it. So,
yeah.
Okay.
And,
thanks a lot.
Any final remarks?
Yeah. Any final remark? All right, then let's close it. Thank you very much. We'll see you again. All right.
Thank you so much.
Thank you.
Thank you.